Because absolutely no one wants to move twice. Here's how to buy a new home before selling your old one. 6 ways to buy, then sell. A tax-free loan from your brokerage account, a home equity loan or line of credit, cash out refinance, a loan from your 401k, getting a gift from a family member, making a smaller down payment, or do a sale-leaseback contingency on your old home. A securities-backed loan is a type of loan that uses your brokerage account as collateral. It's essentially a bridge loan from your investment account, and you can borrow against your portfolio. This is not a good long-term strategy, but it's a very compelling way to get a short-term loan while your existing home sells. The interest can be tax deductible, subject to the regular limits. There's no tax from selling investments in your portfolio, and you stay fully invested. You can borrow a lot, probably more than anyone really should. It's quick, it's easy. There's usually no fees. There's definitely no closing costs like there are when you get a traditional loan, and the payment options are super flexible. As with anything, there are risks, but when this option works, it's a really great fit. The second way is tapping home equity. This is usually a HELOC, which is a second mortgage, and that's something that you might be able to take out on your current home or potentially the new home too. You could also consider doing a cash out refinance on your existing home, but that option usually isn't as good as the HELOC is. On your current home, you need to make sure that you have enough equity to do it. Usually it's a combined 80% loan to value. Getting a HELOC on the new home could give you some extra flexibility. Remember, all mortgage debt on the underlying asset, the home, will be due in full once that asset is sold. So if you get a HELOC on the new home, it could give you a little bit more time to either carry it or to pay it off. A cash out refinance on your old home could be best if you have a whole lot of equity built up and are concerned that your home search may take a while. This is just essentially a new mortgage. This usually isn't the best option. Regardless, your debt to income ratio will need to include all mortgages. So make sure that you make enough money to carry it when you're going through underwriting. The underwriter will not care that you plan to sell your old home. It doesn't matter. You also need to get a HELOC before putting your house on the market. This is super important. Plan ahead and then just wait to draw on the line until you're ready. This also offers a tax deduction subject to the usual limits. You will need to consider closing costs, any other fees that come along with this, variable interest rate, and make sure that your expected cash at closing on your old home will be enough to satisfy all the debt. 401k loan is another option. If your retirement plans allow, you may be able to grab up to $50,000 from your 401k as a loan. Pre-tax 401k contributions will mean a pre-tax loan and therefore after-tax repayments, usually done by payroll deduction. This can be kind of frustrating because when people sell their old home, they have the proceeds in hand, but it might not be possible to pay this loan off in a lump sum. Understand from the plan administrator what the rules are. Keep in mind, if you're planning a job change, this loan will be due in full when you leave. The benefit of this is that many lenders see 401k loans as borrowing from yourself because you really are. So your debt ratio usually isn't affected, but there have been studies that show that this does hurt investors in the longer run. So that's certainly something to think about too. Another one is a gift, the bank of mom and dad. Who doesn't like free money? From your perspective as the home buyer, this is really a great option. Again, free money. But you want to make sure that your parents understand the potential ramifications. There can be gift tax implications if they want to structure it as a loan. There's minimum federal interest rates to avoid gift tax issues, and then it could count towards, again, your debt to income ratio. Another option is to put down less than 20%. This is great if you're a veteran and can get a VA loan, but if you're not, then it can be a little bit harder to navigate. So depending on your credit, the location you're looking to buy in, the purchase price of the house, the target down payment, all of these factors, there could be a way to put down less than 20% with or without PMI, private mortgage insurance. This is a lot harder when you have what's called a jumbo loan. There's no one amount. It's all based on a region. So look at what the conforming and non-conforming loans are in your area. Putting less down means a higher monthly payment, which will impact your debt to income ratios, what options you have in terms of lenders, because it's a riskier loan, as well as the interest rate that you get. Importantly, your offer likely will not be as competitive if it was a full 20% down or obviously an all cash offer. So this could really hurt you there. And keep in mind, doing a smaller down payment, then paying down your mortgage when your old home sells will not change your payment or your interest rate. you need to get the lender to agree to recast your mortgage to change your payment, or you'll need to refinance to change both the rate and the payment. The last option is the least favorable, and that is negotiating a sale-leaseback contingency on your old house. This will essentially give you more time to buy a home without having to move into a short-term rental and give you cash in hand to buy that next property. You would need to negotiate with the buyer to find out how long you can rent the property back from them after closing and to find out what the rent will be. In a competitive market, any type of contingent offer might be difficult. Your prospective buyers are probably trying to navigate buying and simultaneously selling too.